Hi there, Paul McKay here with the Four. I've got Aaron Ulinder, CBRE Vancouver, with us today to talk about what's happening in the commercial real estate market out there, specifically what information might be of good resource for occupiers of space and business owners. How are you?
Paul, I'm well. Appreciate the introduction.
100%. What's happening in the Vancouver market?
Well, I feel like I've been saying this for about 3 years now, but it's pretty dynamic. We've seen a lot of change. I think the best way to describe where our market is today is to better understand where we came from pre-pandemic.
Yeah.
Vancouver's a small market, right? We're a small market. We're a well-diversified market, and we've had a pretty good tenant mix, and I'll reference why that's important later. But our tenant mix has been branch office oriented. So we're not a head office city. We've got a lot of service oriented companies, and we've seen some pretty steady growth. Vancouver generally is somewhat insulated from all the cycles that we've seen, the good, the bad, the ugly.
Pre-pandemic, Vancouver was 2-3% vacant, 5%. It was a very tight market for a long time.
Yeah. So pre-pandemic, we saw a tremendous amount of demand. Our vacancy rate got statistically down to 2.3%. But if you knew what the stats actually, what was truly available within that 2.3%, it was probably half. So think about it. Our market in the downtown core is 25 million square feet, was 99% occupied. And our inventory, for the most part, downtown is owned by 5 or 6 institutional pension funds with virtually no debt, which is very different than the US.
Oh,
so we've got a very stable market. We had incredibly low vacancy rates, and what transpires, advisors like ourselves, when you're faced with a market that's very accretive in nature, is we did a lot of bring forward business.
Yeah.
So we were having conversations with our clients as exclusive occupier representatives, suggesting, okay, your lease expires in 24 or 36 months. You should be thinking about it. If you don't extend now, it's going to hurt more in 12 or 18 or 24 months from today. So when the pandemic hit, we had 99% overall occupancy, and we had no real exposure within those 5 institutional landlords because they had no roll on their leases for about 3 years. So we didn't see actually a lot of pain as a result of the pandemic. Now the sublease sector, sure, different story, but that story is evolving. We've seen a shift.
That's more of a tech story, isn't it, than necessarily, or is it partially tech, partially the utilization rate of office space has dropped because of work from home, and a combination thereof?
Yeah, a combination thereof, and it evolved. So at the beginning of the pandemic, the smaller shops that were, again, the traditional Vancouver tenant was 5,000 square feet and has been. I've been at this for 23 years, many years prior to that. That's evolved. But that small 5,000 square foot tenant with 20 employees, they were putting their space on the market right away. They were recognizing that they needed to take action. And we saw a spike. So we saw that 2.3% vacancy jump to about 7%. But the majority of that space, again, was under 5,000 square feet. There was only 2 or 3 years of term remaining. And today, none of that exists. But what we're starting to see, and what truly fueled the growth leading up to the pandemic, was our US-centric technology companies taking a tremendous amount of space, but now also giving back a tremendous amount of space. And our vacancy rate today, I think for Q1, is just over 10%. And I'm not very popular for saying this, but my opinion is we could be bumping up to 13% by the end of the year. And that driving factor is 2 tenants.
Yeah.
So historically, very diversified. Today, not so much. We have Amazon and Microsoft, our 2 most significant tenants, taking huge blocks, well over 2 million square feet between the 2 of them in the downtown core, in a 25 million square foot market, now saying, well, we're not sure how much space we need. Microsoft has been a little bit quicker to bring space to the market, and we're fearful that Amazon's 1.5 million square foot facility at the Post site in the downtown core, we may see potentially, I don't know, and I'm speculating.
Yeah,
we could see half of it come to the market.
Well, this is the exact conversation I had with the cohort yesterday out of Seattle. Sister city in the U.S., tech-based. Those are the two big occupiers, and their comment was they're going to push people to come back to the office 2 to 3 days a week right away, and that's going to be the bellwether of what happens to the entire market, because they have 65,000 employees each,
right?
Like 20 million square feet of space, and how much space will come back to the market is probably going to be determined on what they're going to do from a workplace solutions front.
Right.
Whereas it's less of a footprint in Vancouver, but also less of not the same square footage of an office market either.
All true. It's interesting. We're surveying our clients constantly. How hard are you pushing on a return to work? And nobody has the right answer. I mean, 12 months ago, maybe 18 months ago, we were engaging our workplace strategy teams.
Yeah.
To reconfigure space, to make it more welcoming, to try to encourage the employee to come into the office for retention, for recruitment, to ensure that the culture of the organization was retained. And very few actually made the investment because there was some reluctancy to spend any money. And those who did, I'm not sure it was worth it, because we haven't seen a push. The only push is if the decision maker, the C-suites, if they say, listen, you got to come in.
Yeah.
But then they're faced with potentially an employee saying, well, we're going to go elsewhere.
Yeah, I think that's the $1 million question for everybody. But it's almost unilateral on any survey. 2/3 of people want to be in 2 to 3 days a week. It's never Monday. It's absolutely never Friday.
Yeah.
So you got a bottleneck midweek. You need to you can decrease your space. You can increase your collaboration space. But at the end of the day, you've got to figure out, your utilization rate has gone way down of office space. And there's only so many ways and combinations that you can have a reasonable utilization rate. But it's not the same space you had before. And it's not the same mentality of Monday to Friday, 9 to 5.
I've been saying this for a while, and I'm never very popular for some of my opinions, but I think that if we see a hard landing through this recessionary cycle, the pendulum is going to be swung the other direction, where the employee will not be dictating the days in the office, and I think that needs to happen. I think that a hybrid work model is here to stay. Yeah, to some degree, I think so. I think that we've tested we've proved the concept over the last 3 years. Do I think it's the best solution? Well, it depends on the industry. It depends on the actual task that the individual is doing. I personally, I come in every day.
Yeah, me too.
Our team, we've got a team of 4 who sit in a quad. Our corporate culture at CBRE across the globe is an open plan work environment, and it's for good reason. We collaborate daily. I can't schedule a Zoom call efficiently enough throughout the day, 15 times, to do what I can do when I'm in the office. And candidly, for my own sanity, I got to get out of the house. So,
100%. My wife wouldn't have me. So what do you think happens in the Lower Mainland of Vancouver for over the next 12, 24 months? Does this trickle through and you get to 13% vacancy? Is that, you think that's central business district? Are people, expanding more in the suburban markets? What is somebody that's got, maybe a couple floors of office space or a floor of office space and 50 to 100 plus employees? What do you think what are the conversations you're having with them about, what's happening over the next 2 to 3 years and when to start making those plans?
Sure. Now would be the quick answer on the latter question. To speak to what's happening in the suburban market, I mentioned earlier that the downtown core is about 25 million square feet. Our greater Vancouver regional district is only 50. So half of our inventory is downtown. And the other half is spread through the North Shore Mountains. You've got Richmond by the airport. You've got Burnaby, New Westminster, and Surrey being the other major markets. they're actually all very healthy. The smaller markets, so North Van and say New Westminster, have a vacancy rate of 3%.
Oh, wow.
Not a lot going on there. Now, they're not very deep markets. They're only about 3 million square feet each, but not a lot of movement. As you start to look at the other markets, Burnaby and Surrey, sure, they've got an overall vacancy rate of 6%, but any landlord would tell you that's a very healthy market, and consequently, there's not a lot of leverage to generate on an extension negotiation because there's not a lot of available product, and it gets further complicated by the fact that Vancouverites are lazy commuters, and our public transit system isn't great. So everybody wants to be on the above rail transit or TransLink train line. And if you looked at the Burnaby market, which is in the heart of the GVRD, that SkyTrain line kind of runs through half of the inventory, and the vacancy rate of 6% drops by about 20% along the train. So it's even tighter, and rates have held as a result of that. And I think it's, so you got to be that much more proactive. So in a stable market, as I'm sure you know, we often recommend our clients start thinking about their lease expiry and what to do 18 months prior, right? Yep. For the past 3 years, it's been a different story. Listen, we're in a declining market. Wait, let's see what happens. Do I think that we're now close to the bottom? No. Do I think that we'll see the market erode further through the year? As I mentioned, yeah, with a 10% overall vacancy in the downtown core going to 13. Yeah, I do. Do I see landlords dropping their rates? Not yet. Do I see an increased level of motivation amongst the big institutional landlords? Yes. And we're not seeing head lease rates drop. We're seeing creative deal structures where the landlord is providing the inducement in the form of gross free rent outside of the term.
Right.
So
they want to preserve building value, so they're paying for it and buying it up in different ways.
100%. Yeah, and it makes sense for both parties. I've got
institutional landlord game.
Exactly. So I've got a one client in particular that I'll reference on this note. They're a full floor tenant. They're coming off of a sublease where we struck a very opportunistic deal. They had a good representative, but the market cycle, I think, did most of the work, despite my best efforts. And they're coming off of 12 net. Market in their building is probably 35. We know that the market will court that tenancy with a bunch of gross free rent. So that incumbent landlord is now talking about an effective deal in the high 20s and potentially staggering the delay between the expiry of the sublease and the commencement of the head lease by 6 months. Well, guess what? It's not going to be enough. We've got an institutional landlord in a far better building offering 14 months of gross free rent on a 4-year term with rates that are, 14 months for free and then a market rate of 41, 42, 43 for the balance of term. If you're the tenant, it's a no-brainer. Yeah. I'm moving up market. I'm not paying any rent for over a year, and then I'm paying a market rent. Yeah, sure. Why not? Let's do that deal. So
that's pretty common to see in more depressed markets or more kind of an equilibrium market anywhere else. But to hear that out of Vancouver kind of shows the increased motivation from landlords.
And it's not every landlord. So certain portfolios have more exposure. Certain landlords are more creative, as you know, right? And this particular landlord's looking at their portfolio. They've done nothing wrong. They're an excellent landlord, but it just so happened they had a number of leases expire, and a number of those tenants moved into new product, which we haven't talked about. Yeah. And as a result of that move, they've got all this vacancy. And unless your space is improved, potentially furnished, and in excellent condition, you're sitting on the bench.
Do you see in Vancouver the race towards buildings with amenities like everywhere else, or has that not necessarily been the case because your market's been so tight? Landlords haven't had to use amenities to obtain leases.
Yeah, I think the big players recognize that they have to differentiate, and they're differentiating through all the normal stuff, right? Make sure that the lobby's activated, put good services down there. You know, ensure that the common corridors and bathrooms are not 20 years old, 30 years old, 40 years old. They're spending money there, and to trip facilities for those who are commuting, cyclists, better gym equipment, newer gyms.
They've got a gym facility, a conference facility generally.
Like it's check, right? Yeah. So all the, for the most part, all the big players in Vancouver have been running with that for a long time. On the new inventory side, so we saw, call it 4 million square feet kicked off. And again, you have to appreciate Vancouver has never seen the growth that we've just come through pre-pandemic.
That was 2021, 2022 construction as well. It was a construction race for office space, but most of that, or a good chunk of that, was pre-leased. But that there's going to be some trailing effect of tenants taking that and leaving something behind. And so that kind of filters out.
Well, candidly, because there was, call it 4 million square feet through 2018, 2019, 2020, that, well, less so 2020, but definitely 17, 18, 19, that was being marketed for pre-lease. And these landlords and developers saw 75% of their exposure gobbled up. And again, it was predominantly this US-centric technology companies that were coming into Vancouver, and they're not taking 5,000 square feet. I mean, Amazon and Microsoft are fun to talk about, but these groups were taking hundreds of thousands of square feet, and in those two instances, well, I should specifically say Amazon, well over 1 million square feet. Huge impact on the city. So we had all this demand that pushed our overall vacancy rate in existing inventory down to 2.3%. But on top of that, we had millions of square feet being leased in this pre-leasing activity. So it's just been an incredible ride in the city, and has set us up very well to weather the storm that is the aftermath of the pandemic. But we're not immune entirely, right?
Well, and I think it sounds like from a business's standpoint, Vancouver is just a healthier place to look at opening up, because you're probably getting larger tenant improvement allowances. You're getting free rent. You're getting incentives to offset the cost of starting or growing or occupying your business in real estate. And that probably helps Vancouver over the long run of attracting and retaining organizations, I would assume.
Yeah, absolutely. Not to mention, despite the rain, it's a beautiful place to be. Cost of living is high. That's our biggest knock is it's the cost of living's high. But we've talked about through this conversation a number of times, US-centric technology. A big driver it's an immigration play. It's a currency play, and it's an availability of educated labor force. We have the trifecta. We've had it all. That's why our market has done as well as it has. Not to mention time zones for the Seattle market and the San Francisco markets, of which you've mentioned.
So the technology industry specifically has been hit hard over the last 12 months. I would say at least in North America, probably globally. Has that filtered out? As Vancouver saw its share of layoffs and sublease space that's related to technology companies decreasing in size, and that probably provides other groups opportunities to come in and get space at an even further discount that's furnished, I would assume.
Without question. So we spoke to the realities of who is giving space back at the beginning of the pandemic. That switch, that turns on its head. So we saw a bunch of space below 5,000 square feet hit the market. That doesn't really exist anymore. Now it's full floors. Multiple floors. And we've got groups that have made huge capital investments. So the big technology companies, they weren't taking small blocks, they were taking large blocks, and they were building them out beautifully. So to build a heavily partitioned or even an open plan work environment in the city of Vancouver, you're probably a minimum of $180 to $250 a foot, and that's not including FF&E. Your furniture and equipment. So when you look at what's available, there is a ton of opportunity in the city of Vancouver. You've got Vancouver, you've got the inventory, you still have the labor, but you've got a number of large blocks of space where they're sitting there idle, ready to go. And that's going to represent at a moment in time one hell of an opportunity for somebody who needs the space. Because these large blocks, yes, their contract rates might be for new inventory in the mid 50s going into the 60s net. For existing inventory, it might be in the mid 40s going to, potentially low 50s net, with operating expenses and taxes being in that $20 to $25 range.
Yeah.
But on the sublease, we're seeing the proactive sublandlords who know that they have to lead, not follow the market.
They're pricing it right.
Yeah, they're doing creative things, not unlike the head landlord I mentioned, where they're providing a number of months of gross-free rent, or they're just pushing their recovery expectations down to, say, high 20s, low 30s, and that's what it's going to take. I communicate the same messaging to all my clients, but the reality is, until there's a tenant in the market, you can discount it as much as you'd like. If there's nobody there, it's not going to lease.
You can't draw blood from a stone.
No, exactly. But you know what? Hey, listen, we just launched what I would argue, and it's not just because it's my listing, but we just launched a 34,000 square foot, 2-floor with interconnecting stairwell sublease opportunity at one of the nicest buildings downtown. Perfect location, A-class asset, private decks, a very, very well appointed space. We just launched it, and we've got 8 prospects. So how many of those are real? I don't know. How many of those 8 prospects can take 2 floors or 34,000 square feet? Let's say half. Let's say half. But I'm hopeful there's an opportunity in there. So there's
4 is not nothing. It's a function of price at that point.
Yeah. So is the market slow? Yes. Is deal velocity down? Without question. Yeah. But are there still groups that are out there? Yeah, there are. And are they expiry driven? In some instances. Are they opportunistic? Yeah, I'd say. We are seeing some tenants take advantage of this flight to market, or flight to quality, I should say. We're seeing some tenants take advantage of these situations.
Well, everyone wants to be in Vancouver, especially if you're a technology company. We did a site selection process with a client over the last few months, and there's really 3 places they're probably going to look, maybe 4 if you include Ontario just as a province, and it's Vancouver and Toronto, obviously, probably Waterloo, and potentially Calgary, depending on what industry they're in and who their target audience is. And each one of them have their own, their pros and cons about them. Vancouver obviously is a place people want to live. There's lots of talent, lots of human resources available and trained in the technology industries. But the pain point has traditionally been it's so friggin' expensive, not just on an office front, but a cost of living front. And there's just challenges there. But the nice thing is, I think from a Canada standpoint compared to the US anyways, is that we have more reliably workable immigration laws. So if people come from the US to set up in Vancouver and they can't find this specific talent, it's not hard to bring them from India. It's not hard to bring them from other areas of the world, because their dollars spent to get, visas and green cards are almost guaranteed, whereas it's more expensive with less guarantees coming from the States. So we had a group, they ended up choosing Calgary for, inexpensive space. The specific talent they were looking for on the tech front was more engineering based, which Calgary's got a lot of. And
I knew there was going to be a Calgary plug in here somewhere.
Has to be. I have to support hometown.
Yeah.
But there's that's the process they went through. Those are the 4 areas they went through, and Vancouver was a strong candidate, but they're more in the resource industry. So some of their clients are more nearby here, whereas they do have a strong presence and probably will grow to Vancouver for more of the mining stuff. But I thought it was a cool shout out to the immigration process, and not just the access of availability of people now, but where they can draw them from. And Canada is heavily reliant on immigration over the next decade. So I think Vancouver softening is good for the business. I think it's probably healthy for companies that are looking at where to occupy in Vancouver. I think it's probably healthy for companies in general. I'm a little bit, of unpopular opinion where I kind of like higher vacancy rates. It makes it easier for us who represent tenants that
Exactly. As exclusive occupier representatives, tight market's no fun. I mean, we can always drive value, and there are many ways of doing it, and it isn't always compressing the rent. There's all sorts of efficiencies that can be generated through our processes, but yeah, having a more stabilized market where you're not having to create alternatives, which we've done in Vancouver. I'll give you an example. I mean, our market was so tight that we had a client that flew in, and we were looking at character space, of which there isn't a tremendous amount in the city of Vancouver. But we walked past one building, and the client goes, "Well, what about that building?" And I said, "Well, there's only 7,000 square feet there." But then a moment, like a light flickered in my mind, and I thought, well, the adjacent building is also owned by the same developer. I wonder if those floors are level. Guess what? Turned out they were. We knocked a hole between the two buildings, and this technology company leased 14,000 square feet. Great story, fun to talk about. But it's a lot easier today, right? If I was to pull a survey for 10,000 square feet, I'd have 30 options. Interestingly enough, if I was to pull a survey for multiple floors, and our average floor plate size within A and AAA is, call it 15,000 square feet, I'd have over double that. And it's predominantly sublease.
Wow. Really?
Yeah. Yeah, we've seen a significant uptick in large blocks of space downtown, single and multiple floors.
Very interesting.
Yeah.
Well, I think that's opportunistic for groups that maybe, we're gun shy of Vancouver and what that takes to get into the market. Whether you want to test it out for a short period of time or on a flexible basis or make longer term plans, it makes it easier for those groups to find the spaces that can accommodate that.
Yeah, without question. We're open for business.
Perfect. Well, hey, I really appreciate all your insight today. For everyone out there, Aaron and I have collaborated in the past. He's a very talented individual, what he does. We'll have you back on here. And if you've got any other case studies or things you want to get back on and talk to with the specific audience for the clients that we have that are business decision makers for businesses and occupiers of real estate, we'd love to have you back on and hear more.
Well, thank you for the opportunity. Appreciate it.
Awesome, my man. Chat soon.